Eli Lilly and Company, a name that's pretty much synonymous with pharmaceutical innovation for almost 150 years, stands today as a dominant force in the global healthcare landscape. Headquartered in Indianapolis, the company has evolved from its early days of mass-producing penicillin to pioneering treatments for some of the world's most persistent health challenges. Its current market position is formidable, driven by a portfolio of blockbuster drugs that have changed patient lives and captured significant market share. The company's recent ascent has been nothing short of remarkable, placing it near the top of the industry by market capitalization. That success is a testament to R&D strategy and commercial execution, but it also brings heightened expectations and scrutiny from investors and analysts. The company's success is largely built on a few key therapeutic areas: diabetes, obesity, products that have become household names. That concentration brings vulnerability. The pharma industry is cyclical, defined by patent cliffs and intense competition. Yet Lilly's turnaround over the last decade is a case study in strategic foresight, focusing on first-in-class and best-in-class molecules to reshape treatment paradigms and define the future of metabolic medicine. The most recent quarterly earnings report provided a clear window into Eli Lilly's operational strength and financial momentum. The company reported revenues that surpassed analyst expectations, a trend we've seen for several quarters. Total revenue saw a significant year-over-year increase, driven by extraordinary demand for GLP-1 agonists. Mounjaro tirzepatide for type 2 diabetes, Zepbound tirzepatide for chronic weight management. These products are powerful growth engines, contributing a large portion of the top line and expanding profit margins even as the company scales manufacturing and marketing. Ramping production to meet unprecedented demand is critical, and management said volume, not just price, is the primary driver. Earnings per share came in well ahead of estimates, reflecting efficient cost management and a profitable product mix. But heavy capital expenditures for manufacturing and elevated R&D spending can pressure near-term free cash flow. Investments that support long-term growth, but introduce short-term complexity. The market reacted positively. Lilly raised full-year guidance for both revenue and earnings, reflecting strong uptake of key products. Takeaway: growth is robust and intact, but the high valuation depends on flawless commercial and manufacturing execution in the coming months. For many investors, a company's dividend policy is a crucial indicator of financial health and commitment to returning capital. Eli Lilly has a long, consistent history as a dividend-paying company and has maintained that tradition even through strategic investments. In its most recent announcement, the board declared a quarterly dividend in line with its schedule, reaffirming commitment, though the latest news did not include a surprise increase. The company typically reviews its dividend policy annually, and analysts are watching for the next expected hike, often announced toward year-end. Currently, the dividend yield is modest relative to the stock's high price, common for high-growth stocks where rising share price compresses yield. Strategically, Lilly balances reinvestment in R&D and manufacturing with returning capital through dividends and potential buybacks. Reinvestment remains the primary priority. With continued profits from blockbuster drugs, the company can materially raise payouts in coming years without sacrificing reinvestment, a disciplined stewardship aimed at long-term value. While the spotlight shines brightest on Mounjaro and Zepbound, Lilly's innovation engine is firing on multiple cylinders. Mounjaro, tirzepatide, has driven substantial uptake in diabetes care. Zepbound, for chronic weight management, has expanded the company's reach into obesity treatment. A significant development is donanemab, Lilly's entry into Alzheimer's treatment, approved in key markets for early symptomatic disease. Its commercial rollout depends on complex diagnostics, patient access, and reimbursement, hurdles that will determine its overall impact. In immunology and oncology, Jaypirca, a BTK inhibitor, is showing momentum as a treatment for certain leukemias and lymphomas, addressing patients who have stopped responding to prior therapies. Ongoing trials and conference updates reinforce efficacy and suggest potential label expansions. Partnerships with smaller biotech firms and deals for novel drug delivery and next-gen modalities like gene editing and RNA medicines augment Lilly's internal capabilities. The company is also investing in digital health, companion apps and tools to support adherence, lifestyle tracking, and patient education, creating a more comprehensive ecosystem of care. Together, these efforts broaden Lilly's reach beyond the pill and strengthen ties with patients and providers. An investor must scrutinize the development pipeline, the key to future revenue streams. Lilly's pipeline is regarded as one of the most promising in the industry, filled with next-generation assets and potential blockbusters. A key focus is the evolution of the metabolic franchise, including oral GLP-1 agonists that could offer a more convenient alternative to injectables. Molecules like orforglipron are closely watched. A successful launch could further cement Lilly's dominance. Research into combination therapies and triple agonists, such as retatrutide, targets multiple hormonal pathways to drive greater metabolic benefits. Beyond metabolic, Lilly is investing heavily in targeted oncology therapies and immunotherapies with trials across lung, breast, and gastrointestinal cancers. Its immunology pipeline shows promise for conditions like ulcerative colitis and atopic dermatitis. Drug development involves long timelines, high R&D costs, and uncertain outcomes. Not every candidate will succeed. Late-stage failures can be costly and damage sentiment, so investors should view the pipeline as a portfolio of opportunities where a few successes must outweigh setbacks. For Lilly, the breadth of late-stage assets and strategic collaborations create a compelling roadmap for sustained growth, albeit with the usual industry risks. In summarizing the case for Eli Lilly, investors face a compelling but complex picture, exceptional opportunity balanced against clear risks. The primary opportunity lies in its unparalleled position in diabetes and obesity. Demand for GLP-1 products is immense and appears sustainable. The stock trades at a substantial premium to peers, meaning much future success is already priced in. Any misstep, from trial failures to manufacturing delays or stronger competition, could trigger a correction. For long-term investors confident in the metabolic revolution and Lilly's pipeline, the premium may be justified. For more cautious investors, the high expectations baked into the price may represent too much risk. Ultimately, investing in Lilly today is a judgment on its ability to continue its extraordinary trajectory. The company looks undeniably strong. The question is whether the stock is a great buy at current levels. Do your research, weigh opportunity against risk, and consider your time horizon.